Warren Buffett often talks about this notion in the markets about waiting for the right pitch. That you don't need to be swinging at every single pitch that comes your way. You just need to swing at a couple opportunities and hit big winners. And we're partial believers in that. We don't think you need just a few swings. We like to take lots of swings, but we like to go for home runs. We like to go for grand slams. And our last video, we talked about holding on, waiting, seeing how things happen. We had been expecting a bear market rally. That was certainly a possibility, but we're not going all in on that. And I'm going to talk a little bit more about this waiting for the right pitch notion and how we're applying that to now. So first, let's look at the cards we're being dealt, because that's what matters a lot. My opinion is the earnings are actually looking pretty good. I guess Adobe is dropping some news. Earnings looking pretty good. We have seen this before. We saw this last quarter, and we saw a rally. We saw, that early to mid-August rally. Very similar setup. We were getting earnings. Earnings were looking good. The economy was looking strong. We get up, and then all of a sudden, we have a pullback. And this is what's been happening every single time. We get earnings positivity. The economy is not falling apart. So we rally because, we don't need to worry about the economic worries. And then all of a sudden we start talking about the Fed. And the rallies turn into new lows every single time, it appears. And I think, once again, fine, the economic strength is here. But as the Fed continues to say, interest rates have yet to have an effect. So they're up. They're making it more difficult to price stocks the way we had been pricing stocks in the COVID paradigm, because it's very different than where we're at today. In the COVID paradigm, when rates were 10 years below 1%. And now we're at 4%. And I don't think it's going to stay below 4% for very long. I think this is a little bit of a fear gauge here. And now that earnings are coming in okay, fine. The economy in the United States isn't falling apart. Okay, and I'm not even so convinced on the earnings. I mean, Netflix, yes, they're beating by a good amount. United Airlines, yes, they're beating by a good amount. Netflix is pulling its viewership subscriptions guidance. I think this is interesting, and I think it's very enlightening into why they're going down the ads route. It tells me they've exhausted the premium user base, and now they have to go to essentially the subprime, and the subprime will pay less than normal and experience ads. So, interesting situation. And when one takes a longer term look and isn't just looking for this next week or so, trying to figure out what to do. Ultimately, I listened to Raphael Bostic today, Atlanta Fed president. He just comes right out of the gate and says, he addresses the people. One of the very first things he does is address the people who are doubters of the Fed's actions, who think the Fed is going to over tighten, or who think the Fed is going to cause a recession. The first thing he does is emphasize price stability and emphasize why price stability is important to people at the lower income, how dollars, become more valuable to them when prices go up, et cetera, et cetera, et cetera. Considering food and healthcare inflation was up tremendously last month, I think it's reasonable to assume that the Fed is going to continue on its path and continue to hike. Will they get above 5% on the 10-year? I don't know. But look, the curve should invert if there's a recession. That's what happens. It appears that the economy is still strong, so maybe the inversion is a little unwarranted. I get it. I've heard Bullard, and like many of us might know, that the curve is inverted because at some point the Fed is expected to cut rates, or for rates to not be as much in restrictive territory. However, it's going to be at least all the rest of this year, at least all the rest of next year. There's an inflation premium you have to build into things, assuming a perfect capitalist system which we're heading more towards because we're taking away the artificial stimulus. And it's not like rates are going to go back to below 1% after the Fed is done tightening and inflation is back down to 2%. The 10-year will still probably be at 3 and change. So I don't think we should be giving too much credit to the 10-year inversion. I think it can get up to 4.5% quite easily, but we'll see what happens. I think below 4% is a little too much. It seems to be this is the lever of the market, is the 10-year, and should go back up. As a matter of fact, after hours, it finally went back to 4%. I mean, we're just going to see if anything comes in here anytime soon. You get what I'm saying? I'm waiting for a better pitch. I either want a bigger rally to short or I want some more downside, because Apple, in my opinion, is a huge, well, not in my opinion, this part, it's a huge piece of the market, 7%. In my opinion, the stock is still too expensive, particularly if there's truth to these notions that they are going to cut production. So, I was short the stock, wasn't short, I'm now shorted again today. We'll see what happens. That's today's video. Feel free to ask any questions or leave any comments. And until next time, peace out.